Hello, everybody, and welcome to the December Capital Club session. I'm going to give a little bit of a brief overview here before we go live as people kind of come into the room. Capital Club is what we call our marketing efforts and everything we do within our investment community. We're trying something a little bit new this year by doing an end-of-year recap and then also a forecast. So just some housekeeping matters as we get going here. This session is going to be recorded so that we can reuse it as a podcast and also create some content out of it for our other marketing efforts. So just FYI, there will be, this will be recorded. A run of show here. We're going to spend the first portion doing a 2022 recap. So going over everything that we did the last 12 months. Then we'll go into predictions, what we think is in front of us for 2023. And then we'll open it up to Q&A at the end. We will close at 9:55 in order to make sure that we're mindful of everyone's time and schedule. So we will be done well within the hour to get you on your way on your Friday. Before that, we'll do some Hollywood Squares introductions here. So I'm Brian Adams. I'm the principal and founder of Excelsior Capital. Most of you folks probably already know me, but let's go around the room and have folks just introduce themselves, a little bit of background, and then their role within Excelsior. And let's start with Jared Arnold to my left.
Yeah, so I'm Jared Arnold, the COO of Excelsior Capital. Been with the firm for about 3.5 years now, just dealing in day-to-day operations and that sort of thing. My background was in public accounting on the tax side of things. So that's kind of how I got brought into the Excelsior ecosystem. And 3.5 years later, here we are.
And in order to avoid any issues here between the rest of the guys, we'll go alphabetical. So William, you're up.
All right. Yeah, my name is William George. I've been with the Excelsior team and Brian for almost 5 years now. I have a finance background, joined the team originally in an asset management capacity, but over the last 3.5 years have been primarily focused on acquisitions. So sourcing new opportunities, underwriting them, talking to our investors about them, and so forth.
Willis, you're up.
Hey guys, my name is Willis McCrickard. I've been at Excelsior for just over 2 years now. My day-to-day, I primarily assist in overseeing asset management for the portfolio and help out Sam and William with acquisitions and Jared with business development as well as investor relations. I've got a background prior to joining Excelsior. I was in brokerage for several years, so very familiar and used to the leasing life. So yeah, nice to meet you all.
Last but not least, Samuel.
Thanks, Brian. Yeah, Sam Peacock. Hello, everybody. I've been with Brian and the team for about 5.5, 6 years. I came in as an intern coming out of the Texas A&M Master Real Estate Program. And along with William, I mainly handle sourcing, underwriting, closing new acquisitions, passing off asset management work to the asset management team as well once we've closed, and help with sourcing and raising capital.
All right, thanks everyone. And again, just another housekeeping matter. For those of you that submitted questions, we will make sure to get to them at the end of the session. If you have something in particular that you want us to address, please use the Q&A or the chat button, and I'll act as MC and try to address them without interrupting the flow of the conversation. If you want somebody to go a little bit deeper into a comment they made, please use the button as well, and I'll make sure to redirect them. So Jared, why don't you give us a snapshot of kind of where we were this time last year versus this year, both in kind of the organizational side of it as well as the portfolio?
Yeah, absolutely. So I'll kind of start with just where we are as a portfolio, just to kind of give some perspective here. So over the last couple of years, we've assembled a portfolio of about 105 million of equity under management that equates to about 200 of gross asset value. We're spread across nine different states, primarily focusing on that Sun Belt region. So over half of our assets are in Florida, Texas, Tennessee, and Georgia. It comes out to be 18 different markets, about 1.4 million square feet in total. I think it equates to about 175 tenants, although that's changing quickly in total, with an average occupancy of like 95%. So, 3.5, 4 years or so, we've been able to amass a pretty good sized portfolio. In 2022, however, we did 9 total acquisitions. So of the 25 assets, 9 of them were purchased in 2022. About 36 million of equity added in 2022, which is right in line with where we were in 2021 as well. It's about 70 million of assets under management, slightly below where we were in 2021 added. And that's primarily due to the decreased LTV that we've seen across the portfolio. It's about 370,000 square feet across the portfolio, 5 new markets in 3 states, Florida, Georgia, and Minnesota. And then from an investor standpoint, we saw our average check size increase. I think we were around 165 or so on an average basis last year. We're about 220 in 2022, with 33% of our investors being new in 2022. And then from a just overhead standpoint, we added 2 employees in the last 12 months for about a 25% increase. And then we recently, thankfully, moved our headquarters to about double the office footprint, which if you guys have come to our office in the last couple of years, we were busting at the seams, so it was needed.
And what about from a tech stack perspective or third-party vendors? I know we've spent a lot of time kind of thinking through upgrading a lot of our systems and processes.
Yeah, I mean, the biggest thing that we've seen in 2022 is we're currently onboarding MRI, which is accounting software. It's currently being housed by our third-party property managers. We're going to take that software in-house. It's going to allow us to have visibility into AR, AP, rent roll, those things that is going to make some efficiencies, create some efficiencies from having to email property managers and ask them these questions, and maybe it's a couple of hours before you get a response, or maybe they're on vacation and it's a couple of days. So we're going to have direct visibility into that. It kind of sets us up to be vertically integrated one day if we ever choose to. This is kind of that first step if we decide to go down that route. That's the main thing. We switched over to HubSpot, so a lot of the emails that you all receive, they used to come from ActiveCampaign. They now come from HubSpot. And then we continue to work with Juniper Square, which, if you're a current investor, is our investor relations software to enhance that as best that we can and as much as they will allow.
Thanks, Jared. Let's pivot to kind of the real estate oriented focus. William, if you could articulate the investment thesis that we had maybe going into the year, and how that's changed given everything that's occurred within the economy, the market, the Fed, capital markets, et cetera.
Absolutely. Excuse me. So heading into 2022, which feels like forever ago, we're primarily cash on cash or yield driven. So we're looking for opportunities that were undervalued, whether it be because we thought the market was undervalued, or maybe the asset had been mismanaged by the existing property owner, or for a plethora of different reasons, and put on at the time what was pretty aggressive debt pricing. In doing so, we would be able to hit a pretty nice cash on cash yield, out of the gate, and let that gradually grow over the term of the whole period. Fast forward to today. Obviously, the debt markets have drastically changed. Interest rates are twice as high as they were previously. CMBS is basically totally out of the market for the type of assets that we focus on. And Lifeco is, pretty systematically drawn back as well. So our debt options have changed pretty dramatically. And so to be able to go out and still find yield for our investors, we've had to shift gears a little bit and focus on lighter value add opportunities. And so these can be acquisitions or assets that are maybe 85%, 90% occupied, maybe a little lower, that have some upside in pure lease up, or maybe it's an asset that the rents are substantially under market, maybe 25% under market. So year one, year two of these investments, your yield may not be quite as high as what you're accustomed to seeing from us. But over time, as we execute on our lighter value add strategy, we're able to reach an average cash on cash yield that's in that range that we've been able to achieve over the last 2 to 3 years. It'll be interesting as we head into 2023. It feels like by the end of 2023, there'll be some softening in the debt markets. There should be, some distressed selling as well. So I'm pretty excited about 2023 and the potential that it has. Just the opportunities that will be online. So, that's kind of where we started in 22, how the year went, and where we are now.
So, William, a follow-up question here before I leave you alone. Since you're the resident CFA, what are you personally projecting in terms of interest rate, the Fed, et cetera, and we'll call it moving into Q1, Q2?
Yeah, I don't like to make specific projections, and we were talking about this earlier this morning. It looks like inflation data came in a tad hotter than expected or preferred, and so we may looking at another 75 bips in December. But my expectation, really by the mid to end of 2023, is that we'll start to see some softening. Rates still may be on the the incline, so to speak, but I think we won't be looking at 75 basis points raises. You'll be in that 25 to 50 basis point range. And honestly, people will be looking at, the fact that rate increases will probably be stopping and maybe being lowered in 2024. And so, as you know, markets are, relatively predictive and price all of that in. And as a result of that, I think you'll see softening debt terms. You'll probably see CMBS and Lifeco come back into the market with some stability there. And so I'm not going to predict lower rates necessarily next year, but you may see tighter spreads and more comfortable lenders.
Sam, let's pivot to you. Since you're the sole employee outside of Nashville, would love to hear your thoughts about what's going on kind of within the other markets that we're active in. And again, kind of same type of question, what you thought going into 2022 versus what the trend looks like today.
Sure, absolutely. As far as new markets and markets that we're targeting, really having a flag planted in a lot of markets that we find attractive is a way for us to source new opportunities. So for example, this year we did 9 acquisitions. 5 of those were in Florida, 3 repeat markets, and then one other asset in the Midwest. So the majority of our focus is going to be in the Southeast and in Texas, right? Going into 2022, we had a specific target of Florida, Texas, Tennessee, and the Southeast. Now, we were drawn to a couple of assets outside of the Southeast in Florida and Texas, in Minneapolis and in Detroit, where we already owned an asset. And that's just because we found that those opportunities were very attractive. Now, heading into 2022, we anticipated to still have the same cadence of acquisitions that we did in 2021. I don't think anyone predicted the interest rates moving against us so quickly. The war in Ukraine certainly spurred that off, and it stayed challenging post Russia's invasion. So to William's point, finding acquisitions that we found attractive on a value add basis was very important to us, and utilizing local or regional bank debt on those assets was kind of the key to us closing and the key to us leaving these opportunities to be very attractive once we're able to get those rents up or get that occupancy up. So we were really focused on flex and light industrial. We were really focused on MOBs, and that's what we executed on. So from that standpoint, the thesis didn't really change. It was more so diversifying markets within the states that we were targeting, and also utilizing that different strategy of non-CMBS, non-life code debt, and transitioning over to that local bank debt. And expanding on these markets, as you said, I'm in San Antonio. We are targeting Texas as a larger target market for us. So pretty much all of the big cities and some of the more secondary, tertiary cities. For instance, we own in El Paso. That was a 2021 acquisition, but the metrics are very strong down here. Job population wage growth is going to, I think, still thrive here. Of course, in a recession, you're going to see some tightening there, but generally, we're quasi insulated down here. Now, that's not to say that we can't, feel the same type of pain that happens in a recession, but generally, targeting these markets, we think is going to be really big for us in 2023. Dallas, Fort Worth area is one that we really love. The metrics are great there. There's a lot of product there, and it's just getting those connections with brokers and expanding on relationships you already have is going to be very important there. And touching on Florida, 5 acquisitions in Florida, all in different markets. We really made it a focus for us, and I'd say that's going to continue now. New insurance is going to be tough down there with Hurricane Ian, but we are implementing a master insurance plan going forward. We're still pricing that out. We're still taking a look at that and making sure it makes sense from a pricing perspective and from a health of the asset perspective. But that's going to allow us to add insurance on a larger portfolio basis rather than a one-off basis. And so from there, we're still able to target those Florida markets and still get pricing because we've diversified risk across our entire portfolio. So Florida is still going to be a focus for us, but closing out the year with one in Chattanooga, a little bit more local, is great. We love the Tennessee markets as well. And so I think going into 2023, we're really, really going to be hammering the Southeast and the Midwest to some extent, if we can find attractive opportunities in markets that we know and understand.
So a follow-up question there. You mentioned insurance. Insurance costs have gone up across the board, with obviously Florida being the epicenter, but as these weather events occur, it's not going to go the other way. I'm curious, given other factors like the rate increases that William referenced, or maybe the structure that lenders are requiring now, how is your underwriting changed today for a new acquisition versus what it was like 12 months ago? Sure.
So, well, I'll kind of take this twofold, right? So targeting opportunities that already have triple net leases in place is going to be huge for us and has been. That's something we've really focused on because you're able to pass through that cost to the tenants. And of course, there can be a little bit of slippage with current tenants if that's a huge increase, but coupling that with markets that have extremely tight vacancies, specifically in the light industrial and flex space, you have tight vacancy rates, and you also have not a lot of opportunity for new supply because it doesn't necessarily make sense for those infill locations to place light industrial assets just from a replacement rent perspective. But as far as underwriting and understanding expenses going forward, you obviously have to be very cautious going forward because of that large weather event down in Florida, and having that in place, larger portfolio where we can go directly to our insurance contact and say, okay, well, what is this pricing going to be day one? You're able to lock that in a little bit better rather than waiting until that pricing gets a little bit closer to close and can move away from you a little bit. But I'd say going forward into 2023 and from this last year, the focus has been on getting a really good understanding of where those expenses are and what that inflation is going to look like, because of course our inflation has been pretty rampant. So having an understanding of you need to over exaggerate market expense inflation is big for us, and also having the ability to get immediate expense pricing when we're underwriting is huge for us too.
Well, let's pivot to you on the asset management side. Maybe give us a snapshot, kind of portfolio level, what you're seeing over the last 12 months. And then I want to go after that into more product type specific questions.
Yeah. So, over the last 12 months and like Sam and William have mentioned, we brought on 9 new assets. So a lot of the asset management team's time has been spent onboarding those new assets and managing those on a day-to-day and implementing our strategy, which has been, going in, taking these value add deals and working with the tenants to improve the asset. So typically these flex industrial deals that we have targeted over the last 12 months, some of them have been poorly mismanaged by the previous owner. So we've been able to go in there, work with the tenants, maybe move on from some of the tenants, flip them out, bring in higher credit tenants to boost NOI, as well as, utilize other factors. A lot of these properties that we've targeted, the previous owners, due to their just mismanagement, they haven't been utilizing the right lease structures. So we've been able to go in there, renew tenants, change the lease structure, as well as change the lease structure to put more operating costs on the tenants and boost NOI for us. So the asset management team has been heavily focused this year, primarily on those value add assets over the last 12 months.
And Willis, if you could you just, they're not on the call today because they're busy doing their jobs, but could you talk about Eric and Greg, their background experience and how they've been able to kind of help the overall asset management within the organization?
Absolutely. So gosh, I would say a year and a half ago, we brought on Eric Massey, who is our executive vice president of asset management, who oversees the whole portfolio. He's got about 30 to 35 plus years of asset management experience. So he's been a great asset for the team. And, he's come aboard, implemented his strategies to really improve our daily processes. And then about 7 months ago, we brought on another senior gentleman by the name of Greg White, similar background, 30 plus years in asset management experience. So these two have been crucial members and great mentors for myself for the asset management team.
So let's go product specific and let's break it down into kind of office, light industrial flex, and medical. If you could comment what you're seeing on a leasing perspective, asset management perspective, kind of what the current state of play is, and then what you're expecting in 2023 for each of them.
Yeah, so on a higher level, we continue to see flex industrial and medical office. They continue to be extremely hot products right now. A lot of the markets that we own in have extremely low vacancy rates. So if a tenant were to leave, there's typically someone who's ready to move in, or there's someone interested in touring the space and potentially signing a deal. And we're actually able to push rents that way because vacancy rates are so low. So, for 2023, I expect medical office and flex industrial to continue to be on the rise. We also own a large amount of suburban office, which has been very interesting over the last year or so. A lot of people turn on the news these days and they hear stories of larger tenants, downsize, moving out. So people are very worried about office these days. But I'm happy to say that, we believe that that's not going to be a huge issue for our office portfolio. We're seeing a lot of those news stories and a lot of those larger tenants moving out of larger office buildings downtown in CBD markets, as opposed to where our portfolio is primarily in the suburban market, where the tenants are made up of smaller, local users. Think of an accounting group or think of a local law firm. So one thing we're also seeing in the office markets is, you're really not seeing those large corporate leasing mandates anymore. So you're no longer seeing those 20,000 square foot users or those 30,000 square foot users or 40,000 square foot users touring the markets. It's a lot of smaller local users in the 2,000 square foot to 7,000 square feet to 10,000 square foot range. So we think that, moving forward, our suburban office portfolio will definitely do a lot better than the downtown CBD markets. But it'll definitely be interesting to see what 2023 has in store for us.
So before we turn to 2023 and our forecasting, a few follow-up questions to Jared. If you could comment on K1's timing and maybe our process and systems there for folks, and then I've got another one after that.
Yeah, absolutely. I mean, we're very focused on the K1 front. That's one of the first things Brian told me when he brought me on. So we're already working on that. We actually had a year-end planning meeting yesterday with our CPA, getting together. We send all the items that we can throughout the year, new equity schedules. We're sending distributions to date already so that they can start plugging that stuff in. Within about 2 weeks of year end, once our property management accountants have wrapped up their year end close, we'll go ahead and get those trial balances over to our CPAs, and certainly have an internal goal of trying to get those K1s out before March 1st, which is about as quickly as you can get them done with this type of volume. We've added 9 assets. There's going to be a chance that some of those get pushed a few days, out, but we certainly want to make sure that we get, LLCs and different entities their K1s before their filing deadline of March 15th.
And could you comment on kind of process-wise, how we actually distribute them, how people can access them, that kind of thing?
Yeah, so if you've been with us before, it's pretty streamlined. But if you're a new investor with us, we just disseminate K1s via our investor relations portal. If you have not had a chance to log into that, please shoot me an email. I'd love to get you in there. It's pretty comprehensive and very easy to navigate. There's a separate tax center within the investor portal that will have your K1 for this year, prior years. Everything's housed in there and stored for you to, have ease of access to information. You'll receive an email from us once those K1s are done, simply stating that. We'd love to, if you have any questions, jump on the phone, talk about it, walk you through it. I'm a CPA, our controller. I worked with her at one of our public accounting tax firms together. So, we're always happy to jump on the phone and discuss that. We can't give tax advice by any means, but we could certainly, let you know how things are going to be treated and maybe point you in the right direction.
So along those lines, Jared, before I let you go, would you be able to give folks a little bit more information on bonus depreciation changes from 2022 to 2023 and expectations there?
Yeah, I mean, that's a good point. And if you've been investing with us for a couple of years, you've probably seen that we've been able to take advantage of 100% bonus depreciation. And that came about in the 2017 Tax Cuts and Jobs Act, implemented by the Trump administration. I think it was 2017. As part of that, it begins to phase out in 2023. It goes down to 80% in 23, 60% in 24, and will continue to phase out, from there until it's gone. I do think it's important to note, although we are starting to see it phase out and there's not much chatter at this time, if rates keep increasing at the level that they have, or, a slight slowdown, there is a chance of us going into a recession, and I don't think they're going to want to inject capital like they have in years past. So a very easy way to kickstart the economy is to provide tax incentives. And I think bonus depreciation could be one of those that gets brought up over the next couple of years. Whether or not it'll happen, I don't know. Your guess is as good as mine, but I do think it's worth noting and kind of watching out for.
Yeah, I'll echo that sentiment as we shift into 2023 mode. it seems like the child tax credit is what the Democrats want in return for perhaps extending the depreciation bonus schedule. And to Jared's point, historically, when we've had a down economy or a recessionary period, having that depreciation is a really easy carrot for Congress to throw out there. So again, we're reading tea leaves, but I'm optimistic that they may extend it and or expand it next year. It's one of the things that there could get bipartisan support on. And so it's something worth tracking for sure. Let's move into prediction time for 2023. William, I'd love to hear your thoughts. Kind of the last 2 years, we've been very active. We've made 9 acquisitions roughly each calendar year. Where are you seeing in terms of deal flow, volume, top of the funnel broker conversations here? Do you think that we'll see some distress in the market? Do you think you see an uptick in deals? Do you think this interest rate environment is going to be subdued in activity? What are you believing yourself?
Yeah, so based on what we're seeing and hearing, and Sam can jump in if he wants to, it seems like in the near term, activity is going to be a little slower. Opportunities either need to be extremely compelling, or maybe in your backyard to get a lender comfortable working on it. I should say in a lender's backyard. But rates are high right now, and it seems like they're not coming down in the near term. However, I think and obviously sellers are aware of that. They know that if they want to sell right now, they're probably taking a little bit. They may have to take a little bit of a haircut, and if they don't have to, why would you do it, right? Which leads to your second follow-up question. There is distressed opportunities. I think we will see some of those. We didn't see much during COVID because lenders generally were willing to work with their borrowers. They didn't want to take the keys in that environment, understandably so. So there weren't as many distressed opportunities as we originally thought there might be. However, looking ahead to next year, I think we will. You've got folks that maybe were banking on a nice refinancing or nice loan terms at their current balloon payment, and that simply isn't going to be there. And so the only real option for them is going to be selling. And they basically have a gun to their head in that scenario and have give the buyers a lot of leverage there. And so I do think we will see those opportunities come up. It's hard to know how many of those, if it's going to be a large portion of the activity that we'll see. But I do think for those that are patient, there will be some unique opportunities out there that will be, easy value add execution strategies. So my forecast for next year is that Q1 and Q2 will be similar to what we're seeing now. Slower activity, fewer compelling opportunities, still more difficult to get debt. And then, second half of the year, I feel like we're going to see an uptick, maybe due to some of those distressed opportunities. Hopefully as lenders start to soften their stances a little bit, because they still have capital to deploy. And at some point they're going to they need to do that. And so I think we'll see an uptick on the second half of the year. I don't know, Sam, if you have any additional commentary there.
Sure. Yeah. Jumping in off what you said, really for my prediction on the types of opportunities that we're going to see that are particularly compelling are, like you mentioned, people who have a note coming up that need to find a way to pay their balloon payment. And that could be taking a little bit of a haircut based on valuations that they had over the past 2 years or what they had in mind. Secondarily, and what we've kind of been seeing recently is specifically in the light industrial space, single individual owners who probably own and manage it themselves, or have held onto an asset for a long time and want liquidity and want to, either retire or flip it into a 1031 home or what have you. We're identifying some of those opportunities. It takes a lot of work for Willis, Eric, and Greg and our asset management team. But if you find those compelling opportunities that are either 100% occupied and that individual owner has been doing the leasing and management himself and wants the opportunity or the asset to stay well occupied and doesn't really care about the rents or the rents that have been growing over the past 24 months or isn't paying attention, you have an opportunity to then get in there, right the ship, and oftentimes seeing a 30% plus increase in NOI just based on the market rental rate versus what's in place. Now, that takes a lot of asset management, and that's why we have the guys and gals on our team that we do. They are best in class as far as getting in there and understanding what's happening at the asset and rectifying the issues that might be there from previous ownership. It does take some time. It takes effort and capital as well from the leasing and or from tenant improvement leasing commission perspective. But digging and finding those opportunities, in my opinion, is what we're going to find in 2023 when we find compelling opportunities and assets. So I think a lot of it's going to be in that light industrial space. I think there's going to be some medical office as well. And as far as distressed opportunities, I think we will see likely second half 2023 more distressed opportunities than the first half. But generally, I think it's going to be on both William and myself to do a lot more digging and coming up on assets where we thought it might make sense, but it doesn't anymore. And really getting into the due diligence and understanding, okay, well, this can be remedied or this can't be, or this is what it's going to take to get this asset and the ship righted. That's going to be on us, and I think we're going to be able to execute on that very well. It really all boils down to brokerage relationships. William and myself have a wide Rolodex of brokers that we rely on that bring us opportunities, and oftentimes that single individual owner or group that has a little bit of distress, if they're utilizing a broker, they're going to bring it to people who know that they can close, and that's what we built our name and reputation on from an acquisition standpoint.
Yeah, and one thing I'd like to add, Brian, a strategy that we've employed in the past and had some success with, and we're more so on the lookout for now, is loan assumption opportunities too. You'll see a borrower that maybe bought something 3 years ago, put attractive life insurance or CMBS debt on it in that 3.5% to 4.5% interest range, and they've experienced some nice appreciation, and maybe they want to get out now for whatever reason that may be. And so if you can find an opportunity that has debt in place at much lower than current market rates, that can be a compelling opportunity as well. That's something that Sam and I have started to specifically seek out, in recent times. I just thought that was worth mentioning.
And I would say it's also true for us on the disposition side as well. We've locked in a lot of long-term attractive debt, and we certainly are always talking to capital markets folks about potentially selling via the same mechanism, because we do have expertise there, and it is challenging, but we've done it both on the buy side and the sell side, unlike a lot of sponsors. Willis, you're talking to leasing brokers and tenants directly all day, every day. A lot of our tenants are small and medium-sized businesses, maybe local or regional type credit. Anecdotally, what are you seeing and feeling and hearing in terms of their temperament? Are they optimistic? Are they pessimistic? What's kind of the temperature there?
Yeah, I would say it's right in the middle. Typically on a day-to-day, I talk to all of our brokers in every market, and they're kind of all telling the same story. The COVID has really changed the office dynamic, and a lot of these tenants have implemented hybrid work strategies. So, when you come into the parking lot on our Tuesday and Wednesday, you see that the assets parking lot is quite full. But if you're there late Thursday afternoon or on Fridays, it's pretty empty. So, like I touched on earlier, and, one thing that I see that has become a very common theme in all of our markets is that there really is no more corporate mandate for those 30,000 square foot or 40,000 square foot users. It's all individual, it's all groups that are in that 5,000 to 15,000 square foot range, all local users. So I foresee it continuing to be like that for 2023. And, a lot of the tenants that are expanding now throughout these markets are groups that are there locally that may have, one-off office on the other side of town, and then they need to open another space that's a little bit larger for their team. So yeah, I would say, Brian, it's right in the middle. And a lot of people have really started taking advantage of these hybrid work strategies, where people are in the office Tuesday, Wednesday, Thursday, and then Friday. It's pretty quiet at the asset.
Yeah, that makes sense. I mean, we work from home Mondays and Fridays, right? So I think we're seeing and feeling it ourselves. And along those lines, Jared, would love to hear your thoughts about, we started doing a lot of 1031 work, right, this past year. What are you thinking for next year? And then also, what about the organization itself, our human capital, the growth of the team, or maybe some other tech capabilities that you're seeing on the horizon for us that might be coming to fruition next year?
Yeah, so I'll start with the 1031 aspect. In 2021, with the current administration, we started to hear a lot of commentary about 1031s going away. I think the competitiveness that created has kind of flowed into 2022 to some degree. So we did about 10 million of the 36 million in equity that we placed this year was 1031 investors. A lot of those were larger check sizes as well in a tick structure. In 2023, I expect that to decrease to some degree, but I do think that it'll play a larger role in our overall equity play. So if we're doing less deals, just due to transaction volume, I do think that 1031 is probably going to get closer to 50 or so percent of the capital that we place, and we're starting to target that a little bit more as we gain more experience with it. We want our current investor base to know that's an opportunity for them, shall they need it. On the human capital front, we've grown 18 assets over 2 years, really 19 in the last 2 years, but in 2021 we didn't have our first acquisition until March. So we've done 18 assets in the last 22 months or so. Like I mentioned earlier, 175 to 200 tenants. A lot of work there for a team of 3. They've done an outstanding job so far. We really appreciated all the work that they've done. I would say the next hire is probably going to be an asset manager, maybe a little bit less experienced, someone that can kind of grow into the role and learn from these guys that we brought in over the last 15 months. We'll probably need some accounting help as we climb above 25 assets, and the amount of work that goes into evaluating and processing distributions for that many assets, and managing that MRI software that I mentioned earlier. And then from there, we would love to grow out our marketing team when able to, but we really want to hit on those items that are necessary and most important right now in taking care of the portfolio that we have under management and hope to add to across 2023. And then on the technology front, I've been in communication with Juniper Square a lot lately. They're increasing their capabilities pretty steadily. We've been pleasantly surprised with their new look and kind of the ease of access of information that they've provided. They continue to be, best of market. We'll work on this MRI software. We're starting with the assets that already utilize MRI. There's a couple of different accounting softwares in the property management realm. We'll then move into all of our other assets and onboarding, those accounting teams and trying to, train them on that software. But other than that, I don't see necessarily any new technology. On the marketing side, we'll move into social media, try to utilize that more to educate our investor base and our network. Starting to do more videos, short pieces, little blurbs. I did a couple on 1031s this week, just trying to provide education the best that we can and be there no matter what mode of way that you get your knowledge base. So, LinkedIn, Instagram, TikTok, Twitter, our website with the resources that we provide there. We want to be available for all demographics.
And as we shift into Q&A, if you want to hear my thoughts on the geopolitical realm, I've got a newsletter series going on right now about depopulation, deglobalization, deindustrialization, depopulation. It's not all as negative as it sounds, but you can access all my commentary there, and I'd be happy to talk to you offline about what I'm thinking and seeing about the world broader picture. But I do feel like we're in a long-term inflationary environment. I feel like we're in a slower growth world, and there'll be increasing fragmentation, volatility across the world. That being said, I think that's actually net positive for the US. And again, you can hear my commentary probably best within the newsletter. And I'm starting to do some solo episodes of my podcast. My marketing team is pushing me to get outside my comfort zone and see if you want to hear me pontificate about that. You can check those out. So I think we addressed some of these, but I want to make sure we get to them in a little bit more granular setting. Willis, let's start with you. There's a question here that was submitted beforehand. And again, if people listening have specific questions, please use the Q&A button or the chat function. I'm happy to have the folks address them here. But Willis, within the office market, what are you seeing in terms of lease up, vacancy, urban versus suburban, Class A versus Class B, and again, within the office sector in particular?
Yeah, so I touched on that a little bit earlier. The one major thing that we're seeing a lot of from an urban versus suburban perspective is you're seeing a lot of these kind of downtown markets. For example, I'll use Nashville, where we're located. You're seeing higher vacancy rates in kind of the downtown CBD markets, where individuals just or where tenants are not leasing space, or if tenants are leasing space down there, the occupancy rates are just lower. People are just not going into the office there. So I think suburban markets have a large advantage right now over the downtown CBD markets. From the perspective of lease ups and what we're seeing from tenants in the markets, it's definitely right now a tenant market. Landlords are having to be more competitive with the concessions and the packages that they offer these tenants. For example, we're negotiating deals right now and at some of the vacant spaces at our office portfolio. And we're having to give, larger TI packages to bring these tenants into these spaces, because it's a tenant market. So a tenant is really able to pick and choose which market they want to go to. Yeah. So, to wrap that up, I would say, we think we're better off, and we're well positioned in the suburban office market as opposed to the downtown urban areas.
William, we've got a question here about the impact of interest rates on the medical office building space, if you could comment.
Yeah, I mean, within our existing portfolio, all of our debt is fixed. So we, within our existing medical portfolio, so no issues in anything we own. And the impact of rising rates, it's the same broad effect it's having on every asset class, right? It's just either you've got to be comfortable accepting a lower return profile because interest rates are higher right now. They're not, you're not really seeing interest rates lower for a medical office than you would flex industrial. It's generally the same interest rate range, which is higher than it has been considerably. And so that's left us in a position where you've got to either be more comfortable with lower return profile if you want a really high quality asset that's already, fully stabilized, or you've got to focus on opportunities that have some upside that you can execute on, whether that's below market rents, maybe it's not fully occupied, or any other potential reason that could be out there. So I don't think medical office really tracks differently than the broader market. Interest rates are higher, so it's curbing activity for the time being.
And then Sam, the last question here, and then I've got a lightning round of more fun non-real estate questions if you guys are up for it. What about asset class focus in 2023? And maybe if you could also comment on kind of core plus versus value add, where you think we'll be if you were going to look at this 12 months from now.
Sure, happy to. Yeah, I mean, as far as asset class focus, I think it's really going to be a similar story to 2022, medical office and light industrial, maybe leaning a little bit more towards light industrial because generally that's where we've seen more upside and kind of expanding on my earlier point, more mismanagement and kind of owner leasing and management, right? So from that perspective, I think we're really going to see a lot more opportunities there, specifically within our brokerage community. As far as medical office goes, to William's point, with higher interest rates, it's probably going to be a little bit lower yield and lower return profile because generally those assets are a little bit higher quality and have stickier, longer term tenants. So you're not as able to bump rents as quickly if you have the market and market conditions too. As far as value add versus core plus, I'd say we're probably going to be trending a little bit more towards value add, whether it be from an occupancy standpoint, 80% occupancy and some lease up to be done with a professional leasing team, or again, kind of that stabilized 100% occupancy, 95% occupancy, but very low rents comparative to market. So I think we're going to lean more towards value add. But certainly we could see some core plus opportunities that have attractive pricing just because the seller wants certainty of close and they want to kind of rid their portfolio of that asset.
Okay, so let's do a quick lightning round, something fun. I don't think anyone's got any questions, and we'll do this alphabetically. I want to hear each of your predictions for World Cup and college football playoff. Jared, you're on the spot. Go.
Gosh, World Cup, I haven't watched since the US lost. I'm going to go England. I think they're still in it. Couldn't tell you if that's not right.
They play tomorrow.
I apologize.
Right. Yeah.
All right, let's go. College football playoff. Sam will appreciate this. I'm going Georgia Bulldogs all the way.
Oh, yeah.
William, you're up.
Yeah, I think I'm going to lean Argentina in the World Cup. Croatia is who I'm pulling for, but I don't think they have the muscle for it. I feel like Messi will finally get it done for Argentina. If Sam wasn't here, I would say Georgia is going to win the playoff, but because he is, I'm rolling with Michigan.
Willis?
Yeah.
A reminder, the Ravens don't play in college football. They're an NFL team.
Yeah. College football is kind of tough for me. I'm a big NFL guy. But let's start with the World Cup. I love the World Cup. It's one of my favorite sporting events of all time. Personally, I think Brazil's probably going to take it. Really young team, I don't think anyone really compares to them. I think the Netherlands are a close second. I think England's overrated. They've got too much pressure. They haven't won it since the late 60s. I think as a whole, they're just feeling the pressure. From a college football perspective, I'm going to go with Michigan. I would love to see a non-SEC team win the whole thing.
All right, I guess on the last one here, yeah, I'm going to go Morocco, underdog story because I'm taking the dogs. UGA grad 2016. I don't think anyone can touch us, but hey, who am I to say it, right? Anybody but TCU, frankly, because my life will be miserable down here in San Antonio if TCU wins with all my buddies.
I like it. I'm going to go Netherlands just to make the U.S. loss look a little bit better and reduce the sting. I think they've got the strength up the middle, and I don't know. I'm just excited for somebody maybe a little bit different. College football, I'm with Michigan. I'd love to see a non-SEC team go, and I'm curious to see what Jim Harbaugh would do as a celebration and just start headbutting people in the crowd. So, well, thank you all for joining us and for listening. Again, this is recorded. So if you want to come back and listen to specific episodes, hold Jared accountable for his K1 scheduling promises, you can go back and listen to all of that. I wish everyone a happy holiday. I hope you guys have fun. You're healthy, and I'll do a public service announcement. This time of year can be really fun. It can also be very stressful. So please, if you need to talk to somebody, reach out. You've got a friend here, and I hope everyone stays safe. Take care.